Hey, welcome to the live stream. It was a green day on Wall Street. Good to see. Man, we needed a green day. It was a pretty brutal week last week, so it was nice to see a green day. I wanted to review the market, see what happens, see if there's any news that's moving the markets, and take a look at a few stocks that I had in mind, but I will take some suggestions from viewers if you have any. So bring them up. If there's a stock you want to look at, bring it up. Let's talk about it. Let's see where it's at. We looked at a couple this morning that were interesting. One of them was Disney. The other one was Hims. It looked good. And I actually did a deeper dive on Disney already and really like what I'm seeing. They have a ways to go, but they put in a lot of work. You can see their cash is really increasing, which makes them more valuable. And that's a good thing. So give me a second here to get my bearings straight, and then we're going to get rolling. So looks like I've got what I need to go operational. So let's get started with this live stream in 1 minute. Everybody, I'm going to be live streaming every morning before the market opens at 9 a.m. Eastern, 6 a.m. Pacific. If you want to join me at a market open, that'd be great. That'd be awesome. The more the merrier. Great to have more people join. And of course, you can catch my YouTube channel if you want to see recorded videos and analysis. That's where I'm at. I just realized my mic was not in its proper place. So hopefully you can hear me a little better. Hey, everybody. Welcome to the live stream. So let's get started with looking at the markets. It was a really nice day to come back. The NASDAQ was up 1.16%. Russell didn't make a lot of noise, just up 0.3%. S&P, very influenced by the Mag 7 stocks, which is most of its weight. I mean, it matched the NASDAQ exactly where it went. The Dow actually outperformed them both. The Dow is made up of 30 companies. These are really well-known companies. So it did quite well today. Very good. Let me look at some news out there. So I didn't see any big stories out there. Apple, I think what was interesting was, let's take a look at Apple, because Apple announced a bunch of announcements on their product. And I don't know that the market loved what they heard, at least for part of the trading day. And it looks like it ended, right? The market really rallied, but they announced a bunch of stuff. And the market was like, that's all you got? So I don't think it was the result that Apple was looking for, but let's take a look at the story really quick and see what it was all about. So they just announced a new iPhone 16, iPhone Pro. I mean, these announcements, an easy job would be with their marketing department. You just take the last 10 announcements and just change a few words and you're good to go. So that's really a way of me being sarcastic, but really it's close to the truth. They've been updating this phone, but fundamentally it's an iPhone. We know what it is. There's nothing transformational about it. Meanwhile, their competitors, there was another story that I saw out there that caught my attention. Now, we can't buy Huawei product, but their competitor has this phone in Asia. And the thing about Huawei is it's sold in Europe, it's sold around the world, it's sold in Asia, and they have this phone that basically will fold in two different places and become a really small item in your pocket. That is kind of cool. I would like a smaller phone in my pocket. And this is their competitor. Apple's competitors are really showing up, doing a lot of innovation with their product. And I think that's the biggest headwind that Apple has is, are you going to keep developing new products? And these are new products, not, hey, we're going to enhance the iPhone. We know the iPhone. They're hoping that a lot of people renew their phones, but your choices out there, like Samsung's got a foldable phone that looks really good. And I've always liked Samsung hardware devices. I was a Samsung guy for a long time, and I really liked their product. And moved away from it because my family's on iPhone. But I'm thinking of going back either to Samsung or maybe trying the new Google Pixel phone. That one looks interesting. So Neil is showing up. It's been a while since I've seen a comment from Neil. How you doing, Neil? Good to see you. They actively do not give a meaningful return to share. I agree with that. And I'm going to dissect Apple. I think that's a good starting point for our stream. So when we look at Apple, and I have a valuation on Apple, let me dig that up and get it ready to go. So here's my valuation schedule. I think I've already got that over there. Good. All right, so I'm operational here. So Apple has not been growing. If you look at their revenue growth, the trailing 12 months is growing 43.43%. That's no growth. Okay, no growth. That's a problem. They should be growing better than that. They're a technology company. They're big, but guess what? Your valuation is massive. They're a $3.36 trillion company. Warren Buffett and Berkshire Hathaway just sold off half of their stake. And I know that a lot of people are downplaying that. And I'm like, he sold half the stake. That means something to me. That means that he's getting out of the position. And that's bad news to me. It's a big revenue company, but it's still, you're paying nine times revenue for the company or so. Net income is really strong. They do produce free cash. And their PE is 33.6 for a company that is not growing. Am I going nuts, or is the stock market rewarding a company that doesn't grow? It's just, I'm trying to get my head around it, but it just doesn't fit. It's like a helmet that's too small or it's too big. It just doesn't fit. All right, so we know that they're not growing. Okay, that could be a problem. It will be a problem, especially if their competitors get stronger and you see this go negative. Oh boy, this stock's going to drop. It's going to drop like a stone. Their balance sheet's excellent. They have $61.8 billion of cash. Whew, that's a lot of cash. So they keep buying back shares. That's what's making that stock work. And their net debt is manageable at 101. And the reason that's manageable is you look at their EBITDA and it's massive. Their EBITDA is 132 billion. So they could pay off debt in less than a year if they wanted to. So that's not a big concern. But if we look at the free cash flow, this is why Apple became Apple. And when you listen to my videos, when you hear my whole philosophy, this is why I focus on free cash flow. Is free cash flow generating companies like Apple get rewarded with huge valuations. The market wants companies that produce free cash flow. So that's why I base my evaluation criteria on free cash flow. All right, so we've got Apple fundamentals. The cash flow looks good. The product, I'm not excited about. But let's keep rolling. So the forecast, 30 analysts cover this stock. And the stock is a favorite of many investors because it's easy to understand Apple. When you look at the Apple stock, you just have to dig into your pocket. You understand the business. They have a smartphone. The technology is very good, and everybody needs a phone. So the marketplace is massive for Apple. Got it. Again, they have a very high valuation of 3.36 trillion, and they're not growing. That's the biggest issue that I have, is no growth. As I look at Apple from a valuation perspective, and let me see the stock price, $220.91. So I think that Apple stock is really, I give them a very optimistic forecast for free cash flows. I'm growing their cash flows, like if they're just going to keep growing, but they're not. And the reason I want to do that is that I just want to make sure that I give them the most favorable valuation and see where it lands. The intrinsic value, $2.6 trillion out of those cash flows. Their cash is not 153. That needs to be updated. And I can update that rather quickly. So give me a second. I'm going to open up those details and update those figures. Now, when I say that I'm being optimistic, the reason I'm being optimistic is that I short this stock. I'm shorting this stock, and I'm kind of making sure that I'm not blind to everything that's potential for Apple. If their valuation really deserves a higher valuation, I want to recognize it. So I'm being as optimistic as I can to see, should I stay in this short position? So they have free cash flow in the trailing 12 months. Cash on the balance sheet. They have 61,801. So 61. And I want to make sure that I'm looking at all cash items because I pull this straight from their financials. Yeah, I think the reason that the website I'm using doesn't look at long-term investments. They have so much cash that they actually put some of it in longer-term bonds. So that number is correct. Okay. The debt did go down, I believe. So let's bring that number down. So total debt, 101.34. It actually went up a little bit. 101. Okay. So we get an equity value of 2.7 trillion, which is still a huge number. It's a massive number. And the market cap is $3.3 billion. It actually is a little bit higher than that. Let me update that number. 3. I need to put a 6 in here. Shares outstanding went down a little bit. So they're priced 20% too high based on me valuing their free cash flows, being optimistic about where their cash flows are going to be. If their business gets disrupted, either with the consumer not wanting new iPhones, not wanting to refresh, those cash flows would be worse. And if their competitors are successful, let's say Samsung, Huawei, Google, then those cash flows could go down. So a 20% premium on this stock, I think, is kind of a hazard to me. I don't want to pay a 20% premium. And the earnings per share, I'm following their earnings per share, and I get about a 20% premium there. So what I've decided to do on Apple is I've actually shorted the stock. And the reason for it is I think over time, it gets harder for Apple. They were late to the AI story. I mean, they're flat-footed. Now they're looking to partner with other organizations and basically try to ride their coattails into the AI paradigm, which I think is going to be, at best, it's just going to be okay. They're not a leader like a Google with their, AI. Microsoft, got a partnership with ChatGPT, invested in that company early. And those companies, I think, are well better positioned than Apple. So the valuation is there. The stock, again, for them to release a big product update and for the stock to be flat on a day when the stock market really rallied, I think that's a symptom of a bigger problem, which is, what are stockholders of Apple thinking to themselves? Is this stock going to be a winner for the future? I don't know. I think for the past year, it's done really well, up 23%. But all stocks have been kind of dealing with adversity lately. But I think it's an opportunity for me to, take a long position against Apple. I've been buying into it. I've got about $5,000 at risk with Apple, but I'm going to keep increasing that amount, maybe get it up to about $10,000. And I'm doing well with these short positions. Short positions are really risky, okay? I don't ever recommend that you do anything I'm doing. I'm sharing my experience. I hope you feel it's interesting. and if anything, educational or entertaining, but it's not any financial advice. I'm not recommending you short any stock, including Disney. I'm just explaining that for me, short selling has been really productive for the last 2 months. It's been incredibly productive. And this short position, I think, is going to get me places. We'll see how it goes. I think it might take a year, maybe longer. In the meantime, I'll hold that position. So it looks like I'd love to hear what you guys think of Apple. Looks like Neil Weston. You already commented on that. Thank you. Mike, the dividend investor guy. Apple revenue is definitely going to rise because I have to buy a phone soon. Well, it's going to rise by your purchase, I guess, and hopefully you buy a nice phone. Cadence Designs. Yeah, we could take a look at Cadence Designs. And then any thoughts on Elf and Humana? Yeah, let's take a look at those. So we'll start with Cadence Designs, and then we'll go to Elf. We looked at Elf in the live stream yesterday, but we didn't look at Humana, and we can look at it. So Cadence Designs it's only up 4%, so it's not doing great. I don't think I got that one right. So CDNS. So Cadence Design Systems provides software, hardware services, reusable integrated circuit design blocks. So they're in the semiconductor industry. Well, they're an application. They're listed as an application. I would have said semiconductors, so I'm seeing integrated circuits, but I think it's in that community of companies. Okay. Now, when we look at these guys, they're a $69 billion market cap company. They're only $4 billion in revenue. So you're paying what is about 18 times revenue for the company. They have a very high PE of 65. The stock is down 4%. Man, it's surprising that if the fundamentals don't look good, but the stock price has been going down. It's down from the high about 21%. And that's why is the AI hype probably got this stock going, and it really ran up. The fundamentals it's hard to value a company because the fundamentals have been so stretched. Fundamentals can't sustain this type of value company. So interesting. All right. So let's look at the fundamentals. From a revenue standpoint, revenue is growing, although single digit now in the trailing 12 months, but previously it was growing nicely. They're a $4 billion revenue company. They're $4 billion, right? They should be growing faster. If they're going to be valued at the rich valuation, you got to be growing faster. Let's look at the quarterly to see where they are quarterly. So they had a bad quarter in the first quarter of 2024. That really affected them. And then 8.61. And I continue to see data like this that leads me to think the AI hype is too high, way too high, because if data centers are being built out at extreme velocities, you would see that a company like Cadence would be actually accelerating their growth. But in the first quarter of 24, which just happened, let's say 60 days ago or 90 days ago, they had a hard time growing. They actually contracted a bit. And then they came back and they grew just slightly at 8.6 compared to their historical growth rate. So that's data that leads me to believe that the AI hype, the hype is higher than the actual valuations in a lot of ways. So this company, their growth is concerning. And I think it's concerning investors, which is why it's being sold off. But let's do our own evaluation and get to our own conclusions on it. The free cash flow is 126 million. It did go down from the trailing 12 months is 126 million. The full year of 23 was 203 million. And it was higher in the past. Look at that. It's been coming down. Interesting. They're probably putting more capital into their factories or into their product. Probably so capital expense, no. It just went up slightly. It did go up substantially in first quarter of 24. I was looking at the wrong data there. Sorry. So the free cash flow for the year is 942. It has been going down from prior years. So the trailing 12 months a little low. So if you have $1 billion of free cash, you're growing, single digit, you're probably a little overpriced. I would say that this company, in my mind, is worth about 15 billion, maybe $20 billion, but the stock price is trading at 69. In the same industry, I could find other companies like Qualcomm that have better fundamentals and are in the same industry. Now, these guys did have negative growth and they're much larger, but if you look at the quarterly, they're beginning to grow. Okay. And when you look at their fundamentals, the PE is much lower. They pay a dividend. The forward PE is really low. When we go back to Cadence, the current PE is 65. Forward PE is going to be 37. And they're not really growing right now. So this one here, I don't understand why anybody would say it's a strong buy. I see a lot of concerns with this company is why did they have a really bad first quarter and then they followed it up with just a okay second quarter? There's a lot there to really investigate, research, and make sure we understand. Last thing is the balance sheet. They have $1.2 billion of free or cash on the balance sheet, and their debt is a total debt of 1.3. So they have a very quality balance sheet. So Cadence Designs, I'm not even close to their valuation. I think investors are beginning to realize if this is going to be a single digit growing stock, all the gains are really priced in. This is just really set to maybe settle down at $150 to $200 per share. And that's a losing proposition for investors. So that's how I see Cadence. Would love to hear what you think. I think they are going to go lower because the fundamentals, they just can't support a higher valuation. Again, cash is where it's at. I believe that cash is where companies get valued. And like Apple, it carries a really high valuation. Even though I think it's overpriced, look at the value of their cash. It's phenomenal. And Cadence doesn't have that kind of cash. All right, so Mike wants to look at ELF and I think Humana. ELF, you recently bought. Okay, so let's take a look at ELF. ELF Beauty, and I think we saw this one yesterday or the day before. Their growth looks really good. So very high growth. They are a little small, but it's over $1 billion now. So that's pretty impressive. Cash, I think cash and balance sheet was fine. What's their total debt here? $304 million. They have a little over 100 million. So I believe they have a decent EBITDA. So they shouldn't have a dunk. Yeah, they can pay their debt off in a little over a year because their net debt's a little over 200 million. They do about 173 in EBITDA. So they could pay that off in a little over a year. So very quality balance sheet. The free cash flow for ELF is, so this is where I had a little trouble with ELF, is they don't have a consistent trend here. We're going from 35, 23, 14, 100, 62, 40. So it's a little bit all over the place. I would guess that they probably, if we took all those numbers and averaged them together, we'd be somewhere like around $50 is the average. And if I value $50 time, a really high growth company, I would multiply that times like 30, and I'd get to maybe about $3 billion in market cap, and they're valued at 6.4 billion. So going the cash flow route would be tough on ELF. My valuation would fall way short of that stock. Now let's take a look at what the earnings per share values the company at, because there's two ways to get there, and two ways that I look at when I'm looking at a value of a company. And let me catch up on some comments here. It looks like, all right. So with the earnings per share, analysts are really in love with this company. They think the world of it because probably earnings per share is growing quickly. 13 analysts cover it. And when we look at earnings per share, it's $2.21. It's going to grow very quickly. That's why investors really like this stock. Now, this is outside of my lane. My lane is really 66.6% of my valuations on cash flow. I can't get there on ELF because your cash flow isn't good enough. The earnings per share looks really good. Some investors just depend on earnings per share. I depend on both. So for me, it would be a pass. But for others, it looks pretty exciting. High growth, earnings per share looks good. If they keep growing and delivering revenue growth with a profit, their stock's going to keep working. And good luck with it. I hope it continues to work for you. And what has the stock been doing in the past? So ELF Beauty. So it's down 15%. It's really come down 47.7%. It's come down that much in 2.5 months. That's a pretty good haircut. Yeah, I couldn't get to a valuation anywhere near their market cap because their cash flows. So, all right. So let's look at Humana. Humana, I think I saw them. They were really down. And Humana is one of those, it's a healthcare payer. It's a health insurance company that pays for people subscribe to it. They pay their premiums, and then you go to Humana when you need healthcare. And these guys have had a tough time, man. You look at their stock, it's really, really gone down. And they first had really collapsed when there was a merger with another company, and I forgot the name of that company. And when the merger was blocked, it wasn't going to happen. The stock really came down. And then it started to rally. I think they put together some really good financials, and it really rallied well. But what happened recently that made the stock really behave the way it did? Let's take a look. All right, so total revenue is growing nicely. And this is a big company, $112 billion of revenue, and they grew at 13%. That's very good growth for a large company. So that looks interesting. Their earnings look good, but their free cash flow is negative in the trailing 12 months. We'll look at that more closely. One of the things that I didn't like about Humana, and I've looked at them over the years, is their cash flow that they generate isn't very good. I own Elevance, and the reason I own Elevance is, let's look at their cash flow. So Elevance is the second biggest. Number one is United Healthcare. I owned United Healthcare for a long time. I owned them from 2016 until I'm going to say 2021 or so. And then I sold them and I moved over to Elevance because I thought their valuation was far better. And Elevance is pretty close to the valuation that we have with Humana. No, this market cap's much lower. I think I was confusing with somebody else. And when we look at Elevance, PE is nice and low. The forward PE is really low. But this one, once you go into cash flows, looks really good. So historically, here's where the cash flows are at. It looks like the insurance payer industry is taking a hit recently. I wonder why. What's in there that's making it negative? So let's go back to Humana and see in their cash flow what is causing cash to go down. So here's cash flow, and the net income is there. It was down a little bit by about 700 million, but it looks like accounts receivable went up. So they're expecting payments from a lot of their customers. And unearned revenue. This was some type of adjustment that was made on the income statement that isn't a cash item, so they had to take it out of their cash flow. So that's what drove that negative number. This and this. So that was a big. Now this is non-cash, so I get that. Interesting. I would want to see them get back on track of being a $4 billion revenue, free cash flow generating company. And then they would get back to a valuation that they deserve. Elevance too, they also have to get back to, getting to their free cash flow numbers that they've had in the past, like, $7 billion. They had $9.6 billion in 2020. I mean, those are awesome numbers. And that's why I invest in these guys. If we go into recession, these are really good recession stocks. They're good stocks for the long haul. They're not going to double overnight, but they really go up in value nicely. So when we look at Humana here, this kind of been a rough ride. I'm not sure what to say about Humana. It's got very low cash. I'd have to be guessing at their cash. If we look at their earnings per share, it's probably going to be favorable because they do have a good earnings per share number. Yep. So their valuation is primarily driven from this earnings per share number and the expected growth. So 2 in a row that, earnings per share is really what's valuing both ELF and Humana. I can't get there because I depend on cash flow, especially for a mature company like Humana. They should have cash flow. They should be good at sustaining very good free cash flow. All right. So Andrew, PC Gameplay, very nice for you to attend. Thanks for the question. HMC is a big guy. I'm looking. Is a big buy, and I'm looking to do as soon as we have a recession. Can you talk about how you think it will play out and during what time frame? HMC. So Honda, I tracked Honda for a little while. Let's talk about it. We all know what Honda does, right? They are principally an automotive company, but they do motors. They do a lot of motors you find in landscaping equipment, industrial equipment. They do motorcycles. And of course, now they're doing EVs with part of their business. They also got into aviation, but I don't think that went anywhere. The company is valued at $50 billion. If we look at their stock chart, not too good, 7%. And car companies have not been valued very well. I'm going to compare them to, I owned Ford, and I just got tired of lackluster results, and I was out of there. The one stock that did work really well is GM. They did really well, but I'm going to compare them to Ford. So Ford had a brutal correction here. They went up nicely, and then they came down a lot. But Honda, back to Honda, they haven't had great results. And I don't know that the traditional auto companies are going to get a very high valuation. I don't think stockholders are going to be excited about it. Stockholders want something, and I would say stock traders want a shiny new object. They want the new Rivian. They want the new car company, right? Rivian has very low revenue. They lose a lot of money, but still, they kind of have a better story about the future. So that's where investors go. Honda is a really good company. They've been producing really good products for a long time, but they don't get the valuation that their numbers are going to drive. When you look at the revenue, you're getting the company for a fraction of their revenue. You're getting it for, 40% of their revenue. Good net income, dividends 2.67. Look at this. Earnings per share is 1.47. The PE is 7. Amazing. This is going to be in yen, and I don't know how to convert that, but we'll just look at ratios here, or growth rates. The growth is there for the company. Very good growth. Cash flow wise, so this is where cash flow really went down, but it was really doing well, and then it really came down. So I'd want to explain that. What happened there? The cash flow really came, just drove off a cliff. It's really low. I think that's what's worrying investors. Now, if you really like Honda and you want to give it a shot, I would make sure that the quarterly, that they really kind of repair things and you see it a repaired business for a quarter, and that they're on their way to being a better company. The free cash flow in the quarter was not good for the first quarter. Q4 was good, but in the most recent quarter, they were burning cash instead of making it. And then they burned cash in Q3 of 2024. So you see, previously, some quarters, they were just killing it. So that's where I would really want an explanation here, and I'd really want to get my head around what happened to cash. Why did it go down so much? What kind of problems are they faced with? Why do they have to put so much capital back into the business? So I'm not excited about car companies. When we talk about car companies, we're talking about a really old industry, an industry that's been around for more than 100 years. And the best I can give Honda is a place in the the gray zone of my desirability. I think the best companies belong in the green, and those are companies like Amazon, companies like Google, Alphabet. But companies in the car business, especially the legacy car companies, it's really hard to put them in the green. They really belong in the gray. And at some point, some of them end up in the red. And because it's just a difficult business. You got to bring so many parts together. You got to spend so much in making the car. And the Chinese are coming to market really strong with cars. In the EV market, I think the Chinese are really going to put up some good products and price them really, really low. And that's going to put a lot of pressure on the other car companies. Some people really want to own a particular brand. They'll pay whatever. I get that. But I think most consumers are going to be happy with an EV that is reliable, that whatever brand it is, I don't care. It's transportation. And if they can get it for half the cost, if not less, they're going to go with that product. And I think the Chinese are coming with that proposition. That's the biggest threat that I see for a company like Honda. So that's where I'm at. I'm staying out of automotive for a while. I learned my lesson with Ford that legacy car companies, as well as some other industries, they just don't get valued well. The other one is airlines. They're making money big time, but they just don't get very good valuations. So I sold United. It was at a modest gain, but I just wanted to get out of it, because if it's not going to be the valuation of the company, the stock price isn't ever going to rise to its level of value, then maybe I just overestimated that the market was going to recognize that airlines were a good investment, and that never happened. So, all right. So we looked at HMC, and it was Cigna that almost merged with Humana, and it didn't happen. And you're welcome, Mike. Good to talk about Humana. What's going on with Nike? Down 25% year to date, and I keep buying Nike. Why do I keep buying Nike? Am I out of my mind? Well, I'll tell you why I like Nike. There's only one Nike. They are clearly the dominant player in athletic footwear. Their brand is one of the most recognized brands, really in around the world. Their athletes, the whole thing, when you put it into that context, you see that this is the dominant company. $119 billion in market cap. The revenue is $51 billion. Now, their revenue has hit a flat period. So they were growing nicely, especially when everybody was getting stimulus checks. And they're like, yeah, man, I'm going to go buy a new pair of Nikes for $300. Great. Nike was happy with that. But now that all that happened, no more stimulus checks, the economy is headed toward a recession, probably a light recession, but some kind of recession. The revenue has been stalled out. Now, I like, really premium companies, quality companies, and I'm willing to buy them at a reasonable discount on a reasonable price. Now, when the company started doing this, which is all of a sudden the market just sold off Nike, I started buying into them, and it sold off, and then it sold off, and I picked up. I started to really buy shares down here. And where am I at with my investment? What's Nike's current stock price? So it's $79.49. I'm going to show you where I'm at with my investment in Nike, and then we'll go from there. So apparel, Nike. $79.49. So after all is said and done, I'm down 4% on Nike, and I continue to buy because I think that Nike is going to be down for maybe a year, and then it's going to be back, and it's going to be one of those where it's going to reward me with a nice 30% gain, if not a little bit more, and really go on a nice run, maybe increase the value of my shares by 15%. I feel that way because there's only one Nike. They're way ahead of everybody else. They just need to reorganize their business and then just start growing. And then the market is, capital is going to seek good investments. And in the case of Nike, it's a very recognizable name. It's a quality name that I think is going to receive a lot of capital. Now, when we look at the valuation of Nike, and I could just jump right into a valuation because I got the information for Nike. So I think they're discounted by 47% collectively. And that's because their cash flows are very, very good. They're hitting a non-growth period, but I don't think that's going to persist. Inflation, especially for apparel, there's inflation in that, so they can grow just by adding inflation. I also think that the Nike brand you could sell other products that are complementary and additional products that you could sell, like apparel. I think they're competing against like Lululemon for leggings for ladies. So there's a lot of areas where they can continue to grow, and they have a really well-established business. I mean, they're generating great free cash. So the cash is really where the value is for Nike in my mind. And I am glad to buy into this company. The one recipe that's worked for me is picking quality companies, and at the right time when nobody likes them, there's a lot of things that are being said about them negatively, and buying them at those times, because when that business comes back, it's really going to be worth a lot of money. I was reading, I forgot where I was reading it, but I believe it was Warren Buffett that said, a lot of people, some investors think that a management team is really important for a company. And I don't disagree that having a management team is really important. But what drives the value of a company? The management team or the business itself? And I know that it's the business itself. If you have a business that just like the Meta business, where it's just high margins, high free cash flow, intrinsically, that's a very valuable business. And if you put somebody who's capable at the helm, that's a very valuable company. The CEO is not that important with regard to the valuation of the company. And I believe Nike is that type of valuable company. The kind of scale and market dominance they have is not replicated by anyone. And I would put Nike in the green because their scale, their network effect, the influence they have, that's going to be very hard to compete with from any player. I know they have some smaller competitors, but those guys are small compared to their scale. Yeah, they're being successful, the smaller players, but they're just basically eroding a little bit of Nike's market share. Meanwhile, Nike is just growing as a whole very, very well. And what's going to be important is that they reestablish growth. And if they can do that, the stock's going to work. If they can't do that, I may be waiting around a little while. So I really like Nike. The drop in a very well-known name is an opportunity. Another story I'll tell you real quick is I really like 3M. So 3M is a company. I'm 56, so I've known of 3M since I was 26. Respected company. A lot of really good stories to say about this company. And when we look at 3M, it's in my mind, in a different way, it's a little like Nike. Historically, it's an awesome company, but it was just beaten up. They had some lawsuits going on. Everybody hated 3M. And the market sold them off by 58%. So yours truly did what I was talking about with Nike. And I bought when people just didn't like the company. And of course, this is what happened. And I'm sitting on a nice gain of 3M. And that's the kind of recipe that I like to follow is pick a quality company. Everybody hates them. Perfect. I know that the revenues are there and the revenues are very sustainable. I mean, 3M's businesses, they're really sustainable. So is Nike. I mean, what are people going to buy when their Nikes wear out? They're going to buy new Nikes. And in the future, when they come out with a product, people will be excited about it. So that's the recipe I've been following with 3M. I followed it with Meta to some extent because people hated Meta in 2022. Price of stock down like 85%. And I was buying shares. Thank you very much. I think in a little bit right now, Google is kind of an undesired company. I love the Google business. So I'm buying shares of Google. I bought more shares today. So that's my story on Nike and why I continue to buy shares, what the story is behind it. So looks like, man, you guys are bringing comments today. Thank you very much. So who started the party on Nike? It was Carlos, I think. And I started to talk about that Japanese yen. Yeah, that's some hard math. So can you look at, so Brad, how are you, sir? So R-Y-C-E-Y. So R-Y-C-E-Y. So Rolls-Royce. And I believe this part of Rolls-Royce makes the aircraft engines. Let's see. Yeah. So they do propulsion systems for air, sea, land. And of course, we think of Rolls-Royce, those beautiful cars, right? But I think these guys are really sticking to aerospace. Let's take a look at their website because I think the Rolls-Royce brand was sold to Ford or Volkswagen. Volkswagen bought the Rolls-Royce car brand, and they're the ones that are now managing that brand. But Rolls-Royce stuck to the aerospace, and it looks like they do these engines for boats, which have to work. I mean, you think about what a boat has to do. These engines are really bulletproof. They're really, really good. So these guys, it's interesting business that I haven't looked at in a while. I think it'd be worth taking a look at. Let's go old school and let's go into their reports for this one here. And this is how I look at companies. Of course, I'm using that website, which I don't get paid anything to use this website. I just think it's convenient. But we're going to go a little extra on this one here and look at their financials and see what they're all about. So I'm looking at their financials within their investors homepage. And these guys are headquartered in Great Britain. So they may issue out financials twice a year. So investor presentation. See the first half results. That's what I'm talking about. So presentation, I think it's this one. All right. So we've got Rolls-Royce. This is an aircraft engine. They make very good engines. It's not a bad place to be because there's high demand on aircraft to be delivered because travel is just through the roof, man. All right, looks good. It's going to be in British currency. We can do the conversion on that. So they do 18% civil aerospace, 15% defense, 10% power systems. That doesn't make up 100%, so maybe they're just highlighting a few areas. Okay, revenue up 19%. Very good. Gross profit up 33%. Okay. They were profitable. Free cash flow was up substantially. And so I'm going to look it up in another monitor here. So British. So each British pound is $1.31. So when we look at this free cash flow for half a year, it's 1158. Why don't we do this? I'm going to value Rolls-Royce. Let's do it from scratch. We're going to do it in US dollars. I haven't looked at Rolls-Royce in a while. I think it's an interesting company. Let me get Rolls-Royce up, and we're going to go through a full evaluation of Rolls-Royce. All right, so we are looking at Rolls-Royce, and the symbol again was RYCEY. Okay, and okay, I'm not sure what weighted average cost of capital I'm going to give them yet. I'm going to look at their balance sheet. But we looked at the first half free cash flow, which was 1158 in British currency. I think it's called the British pound. And I've got the conversion, so 1158. So let's do the math together on that. So times 1.31 times 2, because that's for half a year. So they're doing about $3 billion of cash, free cash flow. So they're growing at 19%. They're growing their revenue at 19%. It's a very good clip. Now I'm going to grow them. If they're growing at that rate, 19%, I'm going to go with 8% growth. And I updated the wrong field there. Excuse me. So 1 through 4, I'm going to grow at 8%, and then long-term growth, I'm going to grow at 4%. Okay. So as we look at free cash flows, they're going to grow in these years, and it's going to get us to an intrinsic value of 62 billion. That's discounted at 9%. For now, I'm going to leave it there. Let's look at their balance sheet and see what kind of cash and what kind of debt they have. So I'm going to open this guy and see if they have the balance sheet next. All right, they didn't give us the financials there. So that's presentation, appendix, press release. Kind of wish they would just give us financials. trying to find the balance sheet. All right, and the other thing about in Europe, they put long-term first and then short-term second, which is interesting. So you have intangible assets, plant, property, equipment. Net debt is 822 times 1.31. And then, so where's the cash? I think they call cash working capital. So their balance sheet's kind of organized in a kind of weird way. Very different than what we do here in the States. Let's see if they give me a different schedule. Here we go. It's looking a little more like we see here in the US. So here we go. So this is where they put long-term first, and then they put cash at the bottom. If you looked at an American financial statement, you'd see cash first. I guess we like cash. So 4319 times 1.31. And I put that in the wrong category, but I'll correct that. And then we want to look for debt and liabilities. So they put that borrowings and leases is 305. And you guys can't read that because it's super small for me, and I imagine it's tiny for you guys. So let me make it larger. So this is what they call long-term debt, I believe, in UK. So we've got contract liabilities. So here it is, borrowings and lease liabilities. So that's going to be 4845 times 1.31. All right, so I think if I look at their cash flows, I do a forecast for cash flows, and then I value the company. It's going to be outside the U.S., so I'm going to keep it at 9. Very well recognized name, but I'm going to keep it there. So I value the company at $61.9 billion. The market cap currently is $54,540,000,000. They have 8,380,000 shares outstanding. And the stock price is $6.16. So it's discounted based on cash flow by about 20%. They don't pay a dividend, which is all right. And they're doing great. For the 1 year, they're up 123%. Holy smokes. Man, why didn't I buy this stock 2 years ago? This one's looking great. Or I should say the last 2 years have been great for Rolls-Royce. But I think it might be a little late to get into this stock. When we look at so that's interesting with the website that I usually use to look at the earnings per share estimates that analysts have. You see, it doesn't have it for this stock. So there's no guidance. I guess they don't provide it for a company like this. Based on free cash flows, this is still discounted to some extent. But my concern would be that, boy, a lot of the gain is already priced into this company. And it just takes one bad story for this stock to really drop. So it wouldn't be ideal for me. I think the investors who bought in this zone, they're making all the money, and the stock's really risen from that point. It's up 475%. Now, are they going to sell more, turbines and motors and stuff? I don't know that they're going to keep growing at 19%. That'd be hard to imagine. because their product is very expensive. So I would pass on Rolls Royce. I think I'm late to the party here. And if I would have saw this and understood it better a year and a half ago, boy, I'd be pretty happy today. But thanks for asking. Good one. Good one to take a look at. Michael Anthony, why did Dan fall today? Earnings was August 5th. Okay, let me catch up I've got a lot of comments, so I'm going to try to catch up real quick. So somebody's interested in DIN. And then there's new, I think it's New Holdings. And then till the end, does Nike have a moat in your opinion? Absolutely. Their whole size, their network effect. If you look at their production, if anybody wants to grow anywhere near Nike's capacity, where are they going to make product? Nike has a lot of these factories locked up. A lot of the designs that Nike has are also excellent. So, Mike, I agree that Nike will rebound, but can't seem to get in. My buy price around $65 per share. All right. And then Dylan Milton. So top stocks for the recession. So I'll comment on that a little later. So it looks like Android PC is buy price on Nike $50. That, it may get there, it may not. All right. So till the end, On Shoes or Hoka, both those brands are popular, but if you look at their revenues, it's nowhere near Nike. I think they're pretty popular, and I think those brands, they're both fairly expensive, so they're premium brands, and they're really working. But if you look at the valuations on Hoka, which is I believe Deckers, I can't get there with their valuation. And On Shoes, I don't think makes money. So it's a popular shoe. They're growing their revenue, but they're losing money. And as an investor, that's not good for me. New Balance is an old brand. They haven't done much. I think they might be kind of cool right now. It's cool to have that N on your shoes, but that's about it. So Brad, I agree with on Google. I bought today as well. Hope it keeps dropping. Well, I agree and disagree too. I hope at some point it gets recognized and it just goes on a really good run and gives me like a nice 50% return per year for a couple of years. And then Mike, I agree. Brad, every $1 or $2 drops, you get a couple more shares. Good. And then Rolls Royce, so they may start paying a dividend. It makes sense because they got plenty of cash. I just, I look at that stock and I'm like, man, that's great growth. Investors were really rewarded on Rolls Royce, but it's not an industry where I could see them doubling the revenue. I mean, it's just not an industry that sustains that type of growth. But, all investors that have been in that stock, congratulations. It was a freaking winner, and you made some money. All right, let's keep rolling here, and we'll do DIN. So Dine Brands Global. So these guys own Applebee's, IHOP, and other restaurants, right? So this is a restaurant stock. Okay. I don't like restaurant stocks. It's a preference. I just think it's a really tough business. Like this quadrant, most restaurants are here. Really tough to operate. Always constantly competing with your competition. Got to hire a lot of people. You got to lease out expensive real estate. Everything costs a lot of money in a restaurant. It's like, man, we get thousands of stocks to pick from. I just don't buy into restaurants. Some of them put up really good numbers of growth, like Chipotle, and that's kind of an exception. These guys are not growing. They're actually losing a little bit of revenue. These guys are sit-down restaurants, which I'm not an expert on restaurants, but it seems like the restaurants that really do work, like Chipotle's, is very simple. You stand in line, you get your burrito, you either sit down and eat it or you take it home, right? And they charge, I don't know, $10 for a burrito. And it's good food. It tastes good and it's nutritious and it's healthy and fresh. So that's all good. And I think the sit down restaurants, I don't know where they are with their demand, but I could tell you, I think a lot of consumer habits are changing from sit down restaurants to casual dining and delivery. Delivery is taking a good part of this industry where people are like, hey, I'll just have my Chipotle delivered, my McDonald's delivered, my pizza delivered. There's so many delivery options where you can just be in the comfort of your own home and get restaurant food. But I think this company may not be ideally suited for that type of trend. Their revenue is going down, so that's a concern. So when we look at their stock price, so Dine Brands, man, whoo-hoo. Doesn't look good. Yeah, doesn't look good by any measure. And when I talk about this, right, that's why I'm talking about it. Is I got to stay out of companies and industries that are in this industry, in this zone, because I happen to believe this is what they do. They're less valuable over time. They never can really expand their revenues, expand their profits, expand their cash flow. They're just fiercely competing against other restaurants. They're competing to be relevant against DoorDash, against Uber Eats, and that's going to be hard because that's a trend. Consumers are moving towards DoorDash and Uber Eats as opposed to, hey, I'm going to go dine in, get full service, get waited on, spend 45 minutes to an hour, getting a meal. I think a lot of people are, hey man, I need something to eat. I want something that's tasty and delicious. Hey, I'm going to order this. It gets delivered. We're good to go. And it's quick. So on the surface, I don't like these businesses that are restaurants, especially these sit-down restaurants. The revenue is dropping when we look at cash flow. They are cash flowing well. They've cash flowed well for a while. But 119 million of cash flow, I'd multiply that times like 5. And it values, you can value it. I still wouldn't buy it because I just don't want to be part of it. It's not a business. It's not an industry that keeps expanding in value. It's actually contracting in value. So I would want to stay out. That's my opinion on DIN. It's been dropping. I don't know when it's going to hit a bottom. Once it hits that bottom, will it rise? I don't know. The only restaurant that I'm invested in is Starbucks, and Starbucks is a different animal, right? Starbucks is mostly coffee, which is simple to make, very simple recipe. They charge a very good price very good price with margin and profit for them. And they are $104 billion market cap. They're number one by a long lead. They're a very sound business, or I should say they're a very valuable business. They do $36 billion of revenue. We looked at this little, Applebee's and so forth. They've been around as long as Starbucks, and they are 821 million. Starbucks is 36.4 billion net income. We have PE is 25, and that's after the stock really ran up recently. I started buying here. Again, recipe, very respected brand. I think very highly of Starbucks. I'm a Starbucks customer. I've been a Starbucks customer for a long time. And when I saw the stock price beaten up like this, as soon as it fell off this cliff, I started buying. And then they hired that CEO and boom, it was a nice bump up. I currently value the stock pretty much where it's trading. And I'm going to delete this because I am not going to keep this. So we're looking at Starbucks. And the current stock price of Starbucks is $92.21. I think they're fairly priced. They're now priced at a small premium. And I'm sitting on a nice gain. I started buying at the right time. My senses were this is another one of those premium companies. It's getting beat up. I will gladly buy the number one player in coffee. And they are classified as a restaurant, but it's a different type of restaurant, right? They are, restaurants, they don't have a complicated, recipe like at Applebee's. And if you order, a hamburger with fries and a drink, there's a lot going on there. A cook in the back is really working hard to make that tasty. Starbucks, like, hey, I'd like a cup of coffee. They push a button and fill a cup and give it to you, and that'll be $4. That's great. Oh, you want a premium coffee? Okay, $6, $7, $8. They pour liquid in a cup. They put a couple other things. They steam it, and they charge you $7, $8. That's a better business. There's more profit. It's simpler. You can grow much faster. And now they have the Chipotle CEO coming over, and we'll see if he's going to grow Starbucks. So that is DIN, and then we're going to look at New Holdings. So Nucor. Now, steel, what's the steel company that's been in the news? U.S. Steel, that I think the politicians are saying they would block that sale to a Japanese company. But these guys are down 29.8%. Now, right now, when we look at Nucor, this is a materials company. And right now, materials are down because we're likely going to go into a recession. It's not a bad time to start looking at these because this is the calm before it starts rallying up. This is where you can pick up, shares at a good discount and potentially it goes up. This is a $33 billion market cap company. You're paying about 1 times revenue for the company. Really low PE, pays a small dividend. Now, things are kind of slow, right? Here's more evidence that we're likely going into a recession or in a recession. It's always hard to tell. And that's why the market sold off so much last week, in my opinion. Two main reasons. 1, stock prices were expensive. 2, we're probably headed into a recession. And that's what caused, stock prices to really come down. So these guys are down on revenue. Okay, understood. They're based on, or they sell a commodity. So sometimes they produce just as much volume, but the price for that commodity is lower. So that's not completely their fault. So, okay, understood. The cash flow. So the cash flow is really good a couple of years ago, and they're still sustaining their cash. Yeah, this is a good one to keep an eye on because if it keeps dropping, these are going to get really attractive. Instead of Nucor, I'm into TX, and they are in the same industry. They actually produce rolled steel, and their principal operation is just south of the U.S. border in Mexico. They're a $6 billion valuation company, almost $20 billion in revenue. They're headquartered in Luxembourg, but most of 60% of their operations in Mexico. Argentina's number 2, and then they have other South American operations, but Mexico, then Argentina. They pay a big dividend. I don't buy stocks for dividends. I buy stocks because I think they're going to do this. Okay, and that's what I'm thinking that's going to happen eventually. I think I'm doing okay on TX because I've been buying at the right levels, and I'm still in the green. And I'm waiting for this particular sector to start moving upwards. Once the economy is defined and we realize that, hey, okay, the economy, we're in it and we're going to get out of it, then these commodities are going to start to rally. And that's when these companies are going to do well. So that's where I'm at with Nucor. Nucor looked like you can get to the valuation, but the price may still come down. I mean, it's a good one to watch, establish, how you want to enter the stock and what you expect out of it. This one here, I would say, follow the news on this recession. Once we get definition of when we're going to go in, when we're going to get out of it, then that might be about the right time to get in. But that's a good idea. I like buying stocks like 6 months to a year before everybody else, because you're buying them discounted. Then a year later, everybody's excited about it, and you're like, yes. If you're lucky, you buy it like 3 months before everybody gets excited. But it's really hard to do that. It's a little easier to see, hey, this stock is being beat up for no reason. Like, I'm going to go with Uber to some extent. It kind of tells the story. And I'm going to go here. So Uber, we all know what Uber does. We all know that, okay? Now the market said, Uber, I don't care that you're growing. I just don't care. I think you're terrible. We're going to discount you by 64%. Thank you very much, market. Thank you so much. I think highly of Uber. There's only one Uber. They're the leader. And thank you, world, for Uber. And thank you for the stock. So steel is kind of getting in this zone. And you could probably, with a good quality company like Nucor is good quality, you buy at the right time. And I don't claim to know exactly when to buy. And then, okay, I'm going to put 50 grand into Uber. I dollar cost average my investment. I know that this is unappreciated, undervalued. So I start buying, buy. My latest, kind of investment is Amazon. So Amazon had this big drop. I, started buying. And I've been buying. And when we have these drops, last week when it dropped on a couple of occasions, I ended up buying $6,000 of Amazon last week. I just accelerated my buy pattern of Amazon because that's one of those high quality businesses. I'm not sure what the market's thinking. It probably is not thinking carefully to discount such a high quality company like that abruptly. I'll take that discount any day of the week on one of the most valuable companies, top 5 most valuable companies in the world. And I'm saying that from they control e-commerce in the United States of America. They are the number 1 hyperscaler cloud services company in the world. I mean, they're very, very important, powerful. They have great moats, all that stuff I talk about. Amazon is right here, right in the center. Amazon in the green. Great company. So enough of Amazon. All right. So Mike, you drive a hard bargain, buddy. You're always looking for better prices, but I appreciate that. I respect that. And I think you should drive a better bargain. All right, guys. So it's been a good live stream. It looked like we got a good number of people tuning in. I appreciate it. Join me in the morning. Open the market together. That's when I get my head in the game. That's when I start thinking, this is what I'm going to buy. This is what the market's looking like. It was great to see some green on the screen this morning. Whew. They call it a relief rally because after a week like the one we experienced, where we had stock prices just tank, you're like, man, what the heck? What's going to happen? And then the market goes up 1%, you're relieved. So that's why it's a relief rally. And that certainly was how I felt this morning when we looked at that up market. I'm like, all right, cool. You're giving me a day off, market. Because I get when you have a market of, going down prices, I get a better deal. And I know I'm going to make money on those stocks, most of them, with companies that I'm buying into. but it still kind of wears on you when you look at your portfolio and you go, how much did I lose this week? You're like, oh man, I get it that it's a little bit of patience has to be exhibited, but it's nice to have some green on the screen for today. Let's see what happens tomorrow. So if you want to join me in the morning, I know it's a little early, especially for you West Coasters, but it's kind of a fun period of time in the day for me of looking at the market. Where's it going to open? It opens up, and then we see where stocks go. And I'll do afternoon streams when I can. That my afternoons are iffy. Sometimes I'm super busy and I cannot get to it. But in the morning, I can probably control my schedule a little better, and I can have that more consistently. So, very good stream, everybody. If you guys haven't noticed, I kind of changed my equipment, and I've got a new computer. I've got a new place where I'm streaming, and I'm probably going to make a lot of mistakes as I stream. So I promise to keep working hard to get better at it, and I appreciate your patience. Any feedback you have on my streams that, hey, you could do this, which would improve, I will take it the right way. I would appreciate any feedback you can provide. And as always, I really appreciate all the comments and all the suggestions on the chat. I want to thank anybody who supports the channel. You know who you are. I really appreciate you supporting the channel, and it really means a lot. I put a lot into it, and just, you showing a little bit of support really goes a long way for me. So everybody, have a good night. Let's hope that it's green for the week, but don't bank on it. We may have a couple of red days. We'll see how it sorts itself out. Everybody, take care. Thanks for tuning in.